Hey, Adam Hooksema here from ProjectionHub, and this is the sixth and final course in our six-part series on how to buy a small business with an SBA loan. And today we're going to be talking about closing the deal. What are the final steps after you have, fully submitted your application to a lender and you've already come to an agreement with the seller. Now, how do we get from that approval to closing and actually becoming a business owner? So that's what we're going to be walking through here today. Before I dive too much into that, just a little bit of my background. So my name's Adam. I spent 12 years as an SBA lender, closed about 1,500 SBA loans during my time as the executive director of an organization called Bankable. And here's a picture of me winning some SBA hardware here from the state director here in Indiana. And, while I was an SBA lender, I started ProjectionHub as a side hustle to help folks create financial projections and ultimately help them make it through that SBA part of the process. And so I've worked with thousands of clients who are going through the SBA process. A lot of them are working on acquisition deals. And so after working on so many deals, I thought, I want to kind of put a free and simple course together that's kind of holistic, that walks a client through the process of acquiring a small business with an SBA loan based on my experience working with a lot of clients. So the course that we've put together here, it's a 6-part course. This is the final course. So if you haven't already watched the other courses, I encourage you to go to the description of the video below, and we'll put links to the other 5 courses so you can take a look at those, where we're just introducing the process of buying a business with an SBA loan, really understanding SBA, finding the right business, doing your financial due diligence after you found a potential target business to buy, and then getting that lender ready package. And that really rounds us out to getting here to closing the deal. So what you're going to learn today, by the end of the session, how to structure a letter of intent in a way that's going to make sense and hold up throughout the process, what happens during the SBA underwriting process, what required third-party reports and conditions are going to be part of the closing process, and then why the 90-day timeline from kind of approval to closing probably makes sense, and then what key legal documents are going to be part of the closing process. So this is really that final step. So we're going to make sure you get across the finish line and know what to expect here. All right, so let's talk about an LOI, a letter of intent. If you haven't already, put together a letter of intent before you go into underwriting with the bank, the lender is going to require that you have a agreed upon or signed letter of intent with the seller. So this is where, you're working on terms of the deal, like what's the purchase price, how much down payment, is there going to be any seller note, things like the working capital peg. This might be kind of a nuanced topic here, but basically the idea is that you want the seller to leave you with some working capital cash in the bank or some inventory, or if that's not going to be the case, if they're not leaving you any cash or inventory, for example, post-closing, then you need to prepare for that, and that should be built into your SBA loan request as well. Contingencies. So in your letter of intent, you're going to put in contingencies like, this letter of intent is contingent on getting approved for financing, contingent on due diligence findings. You're probably going to put something in there about a training period of if you want the seller to stick around to help train you in transition, and then probably a non-compete type of structure depending on the business that you're buying, but you probably want the seller to sign some sort of non-compete. And then finally, a targeted close date. Now that letter of intent is not binding typically. I'm not a lawyer, so talk to your lawyer about this, but typically the LOI is not binding. It shows that your intent, you have a serious intent, and it usually is kind of the first step in saying, okay, now we're going to go into due diligence. This allows us to get all the documents that we're going to need to go into underwriting. And then there is what's called a purchase agreement. This is what happens after due diligence. This is kind of the official legal document contract for the sale. So you probably don't want to work on the purchase agreement until you have final bank approval. Otherwise, you're going to be paying attorneys for work that, potentially you don't even get approved for the loan. And so sometimes I see that mistake happen where clients just assume they're going to get approved for financing. They have an attorney work on the purchase agreement. They're kind of spinning their wheels because they haven't even been approved yet. So I would just be aware of the typical structure here is get a signed letter of intent, then go into underwriting, get a formal approval commitment from the lender, and then have the attorneys work on the purchase agreement. So some major letter of intent terms that you need to be aware of here. So purchase price. So this is going to be important that it is supportable or that can stand up under an appraisal. So every SBA loan for an acquisition, they'll require that the business that you're buying is appraised or gets a valuation. And the lender is not allowed to lend more than the valuation. So think of this similar to your home. If you bought a home and, you had a purchase price for the home of, round numbers, let's say 500,000, but it appraised for 450. Well, the lender's only going to lend based on the appraised price. So you're either going to have to make up the difference in cash yourself as a buyer, or you're going to have to renegotiate that sales price. So that's something that you want to keep in mind when you're making your offer to the seller, that, make them aware that, hey, I'm going to be trying to use SBA financing here. And if the appraisal or the valuation of the business comes in too low, we may have to renegotiate the purchase price here. You also need to make sure that the price allows for that debt service coverage ratio to be, show cash flow. And typically it's that 1.25x or above, again, meaning you have $1.25 of cash flow for every dollar of debt service. So situations where the purchase price is too high, sometimes then the deal won't cash flow, and you're going to end up, something's got to give there. You're either going to have to come up with more equity or lower the purchase price because the loan amount is going to need to be reduced till you get to the point where you're cash flowing. We talked a little bit about this working capital peg, but you're probably going to put in some specific dollar amount that you want assumed to be the working capital that would be left in the business. And this is something to talk to your attorney about. I would really encourage you to work with an attorney who has done a lot of small business acquisition deals, because the working capital piece can be a little bit tricky, and you need to have someone that knows what they're doing in terms of how they structure that. But the key thing you want to make sure of is that you have sufficient cash flow. So sometimes what happens is in businesses where you're getting customer deposits, for example, you're getting paid for something up front, but you haven't completed the work. Well, if the seller takes all the cash that's in the bank account at close, and you've got work to complete still under contract, but they just took the money that the seller took the money that was going to be used to complete that work, you're going to find yourself in trouble. So you need to have a very clear understanding of how you're going to have working capital to sustain the business post-transaction. Seller note terms. So if you are going to do a seller note, you need to make sure that the seller note terms are kind of allowable with SBA or are going to meet the SBA requirements. So this really depends on, the specific terms are going to depend on whether the seller note is going to be used as equity, as part of the equity down payment for the deal. So if there's any portion of the seller note that's going to be counted as equity, or you want that to be counted as equity in the deal to come up with your 10% down payment, then that portion, that seller note portion, is going to be on what's called full standby, meaning you can't make any payments on that seller note until the SBA loan is fully paid off. So a lot of times what ends up happening is folks will do two different seller notes, one seller note for the equity portion, and then another seller note that they can start paying on right away, assuming that the business can cash flow it. So that's kind of the typical structure. And you probably want to match the terms and the interest rate similar to the SBA loan. If you can get a seller note that's more favorable, that's great. If you can get lower interest rate on the seller note or, more favorable terms, go for it. And then training and transition, I'd say 30 to 90 days is typical. You can decide whether you're going to pay the seller some hourly rate for that consultation or training or transition time, I think that probably makes sense to pay them additional, because if otherwise you've paid them their lump sum amount, and it's probably a lot harder to get them to show up and be helpful on day 87 when, 3 months ago they got a big lump sum check. And so to continue to have some payment coming their way, I think probably makes sense. But you want to make sure that you build something in for this transition time. It's a critical piece of success. You're going to find yourself stuck in a situation where you really need something from the seller. And if you didn't negotiate this ahead of time, they're on the beach, they're not returning your calls. It could happen anyway. So just be aware. Like sometimes I've heard of clients who they had something agreed upon with the seller, but then, day 2 after the sale, seller was missing in action, never to be heard from again. So that could be possible, but you should try to negotiate that if you can. Okay, so what is once you have a LOI, an agreed upon deal with the seller, what happens in the underwriting process and kind of through to approval with SBA? So typically I would say 2 to 4 weeks for the kind of underwriting and approval process. There's kind of an initial review from a loan officer. The loan officer is going to, if they haven't already, they're probably going to give you a term sheet with a structure of what the deal looks like. And then it's going to go to underwriting. And that's where the credit analyst is going to do a deep dive into the financials. They're going to verify add backs. They're going to do their own calculation of debt service coverage ratio. They're going to check your credit, your collateral, your background checks. They're going to ask you a bunch of additional questions probably and grill you on some things. And then ultimately that results in kind of a full package that's probably either going to just be approved internally by the credit team, or it's going to go to a credit committee or a loan committee. So it could be useful for you if you find a lender, just from a speed of getting deals done, if you find a lender that can approve things internally, like their chief credit officer or their underwriters are able to have authority to approve loans. That's going to make your process faster. A lot of lenders will have deals go to a credit committee, probably will meet once a week. And that's where, a committee of lenders, leaders at the bank are going to make a decision. And so, you can expect that to slow things down a little bit, probably. But I don't know that it's the end of the world. If you find a lender, we've had plenty of clients who have had success working with lenders who, are going to go to a credit committee. I think that's okay. Just something to be aware of. Okay, there are going to be a number of third-party reports that you're going to have to kind of be a part of or just to be aware of. So we already kind of mentioned you're going to have to get that business valuation or appraisal. This is something that the lender is going to order. So it has to be independent. So you can't hire the appraiser and the seller can't hire the appraiser. It's got to be, third party. You are going to, as the buyer, you're going to end up paying for that as part of your closing costs. So, you can see a cost estimate, maybe I've seen $2,500 on the low end for smaller deals. So $2,500 to $7,500, probably a couple week turnaround. And the big thing here is that you've got the valuation has to support the purchase price. So if the valuation comes in too low, you're going to have to go back and renegotiate or change the terms of the deal. How much is borrowed? How much is equity? Maybe a larger seller note. Something's going to have to fill that gap. So that is one area that can blow up deals. Another area, if you're buying real estate, you're going to have to get a environmental phase 1, which can take some time as well. If there are major issues found, this is kind of just a deal killer that is really hard to get around from an SBA perspective. Franchise documents. So if you're buying a franchise, the SBA's got to approve that franchise. It has to be on the approved list. There's a list of franchises that are approved by SBA. So you got to be on that list. And then also the franchisor's got to approve you as the new buyer as well. So there's kind of 2 parts to that approval process. And then some other conditions or other things that, can jump in the way here. Landlord issues. So if you are buying a business and the, seller has a lease and they're renting a space, when you get an SBA loan, so let's say it's a 10-year loan, you're going to have to have that landlord be willing to sign a lease with you now as the new buyer for a 10-year term. Now, the lease doesn't actually have to be 10 years, but you have to have the option to lease. So you could do like a 5-year lease with an option to lease it for an additional 5 years at maybe a different price or something like that. But really, your lease needs to match the term of the SBA loan. And sometimes landlords, are, especially if the landlord is some big, national real estate investment trust or something, they can be tricky to work with. They may not want to agree to the SBA language, but they really have no choice. They're going to have to agree to the SBA language, or you're not going to be able to close on the loan. Life insurance. So life insurance is going to be required for most SBA acquisition loans, I would say, where you as the buyer, you're going to have to get life insurance so that the SBA loan is paid off if you pass away while there's still a balance on the loan. And that could potentially take a while, especially if you're, not in the best health. It could potentially get in the way. And then finally, one other thing that we often see kind of like holding things up or throwing a wrench in things last minute is updated financials closer to closing. So, you get a set of financials from the seller, and then you're going through underwriting, and then, as part of the closing process, you want the most up-to-date financials from the seller, and then maybe they see some major change, like all of a sudden the business is losing money, or it's way behind pace on sales, or something that, spooks the lender. So you see that happen sometimes as well. So this is an encouragement to the seller to keep sprinting to the finish line. Don't let off the gas on the business during that sale process, because you're going to get yourself in trouble. You may end up blowing up the deal if it looks like you've just kind of given up, the last couple months before the sale. That can really throw things off. So keep that in mind. So here's kind of a visualization of how I think about the timeline. I think it's kind of a 90-day kind of best case scenario. Could it sometimes be 60 days? Yes. Could it be 120 days or more? Absolutely. But there's kind of this initial review, letter of intent, execution. You're kind of getting a term sheet from the lender. That can happen in a couple weeks. Then you're going to go through underwriting 4 weeks to get like a final approval, hopefully. And then another 4 weeks for, the appraisal, the environmental, what other third party reports that need to be done. And then, closing preparation. So the attorneys working through that last few weeks. So that's kind of the way I think about, a roughly 90-day plan to get a deal closed. And just remember, there's there's probably 20 different individuals involved, from the seller to you as a buyer, to the seller's accountant, to your accountant, to the insurance person, the appraiser, the underwriters, the loan committee members. I mean, maybe it's 30 people. I don't know. But, people are going to get sick. They're going to go on vacation. They're going to, any one person could add a week delay in your process somewhere. So it's like, it shouldn't take this long, but my experience has been that it just does. Like, something's gonna get delayed somewhere there in the process. So keep that in mind. Just have the right expectations about timing. 30 days, sometimes people say, how fast can we get this done? Can we get it done in 30 days? If the seller is really, bent on this needs to close in 30 days, then SBA is just not going to be a good option. Like, you just shouldn't even move forward with it, because it's just not going to happen for an acquisition. There's too much complexity, too many things that could slow the process down. So if that's what the seller is set on, then they're just kind of saying, we're not even considering SBA buyers at that point. So what do you need to think about in terms of the legal and the different attorneys that are involved here? So this is where, you can start to rack up those closing fees, because the attorneys are going to start, punching the clock here. But so you've got your attorney, you've got the seller's attorney, and you've got the bank's attorney. And you also have the closing agent or the title company as well. And so you got to get coordination among all of them, which can be difficult. And especially if you have any attorney that's not very experienced in small business acquisitions and SBA loans, then, there's there's some unique nuances that can really throw them off. They might be like, this doesn't seem standard to me. Well, it may very well be standard for SBA loans. It has to be done this way. But if you haven't done a lot of SBA deals, then it can throw you off. So the documents you're going to be signing, or that will be part of this process: promissory note, the loan agreement, basically the security agreement, which is you pledging collateral, personal guarantee, and then if there's real estate being pledged, you've got a deed or trust or mortgage, and then the purchase document. So the purchase agreement, a bill of sale, potentially assignment of contracts or new leases or new customer contracts, or assignment of those contracts, and then probably that non-compete agreement with the seller. So some of the moments that can really throw the deal or mess the deal up in the closing process is that when that appraisal comes in too low. So you thought, you had a purchase price of $1 million, the appraisal says $850. What do? You're going to have to reduce the price. You're going to have to come up with more equity as a down payment, or you're going to walk away. Quality of earnings issues. So maybe you're doing a quality of earnings, or just some point in the due diligence and the underwriting, there's issues that come up, like maybe customer concentration is worse than disclosed, or maybe you thought you had a longer term contract with a customer, but once you really digging in to look at the customer contracts and that due diligence, you realize this contract's almost over, or it just ended last year, and this was a material part of the business, right? Working capital deficit. I'll kind of hit on that on another slide here. Something that often happens kind of last minute, where you realize, shoot, we don't have enough working capital. And then, sometimes we see like a key employee or a key customer contract ends up leaving. And this is a tough scenario, because if you as a buyer are really relying on maybe a key manager to be there and help with the transition, and then they leave, maybe they hear about the sale, or maybe they just find a different job just naturally, and they leave, that could be a big risk for you as a buyer. So you may need to consider walking away. So it can be really painful at this stage in the process to find something that kills a deal, but it's better to walk away from a bad deal than to push through and agree on a bad deal, because you are personally guaranteeing, you're signing your life up here on an SBA federally backed loan. You don't want to default on this. So if you're getting major red flags here in this process, you really should consider walking away. All right, so here's that kind of working capital piece where we often see people not realize until the last minute that they don't actually have as much. Hopefully, the lender, a good loan officer, has helped you realize this ahead of time. They should be helping structure this in the sources and uses process and the term sheet. But sometimes we see this where we think we've got a deal. We think that the project or the acquisition is $1 million, let's say. And so you think, all right, it's $1 million project. We've got a $900,000 SBA loan, and we've got a $100,000 down payment. But then, as you can see here, once you actually get through the process, okay, there's $1 million purchase price to the seller, but we need $50,000 of working capital. We've got lender closing costs. We've got attorney fees. We've got an appraisal. We've got an environmental report. We've got title insurance. And then a major thing I'm not even including here is the SBA guarantee fees. And I want this to be kind of evergreen content, and the SBA guarantee fee will change, and sometimes they'll waive it on smaller deals. But be aware that typically there's going to be an SBA guarantee fee. And so make sure you know what that is. It can be pretty substantial. It could be a few percentage points of the whole loan. And so, it's a decent sized number here that you want to make sure you build into your total project cost here. All right. So you get to closing day. What are the kind of items on the checklist? just to be aware of, things you're going to want to do before closing, final walkthrough of the business. You want to verify the working capital that's being left in the business or the inventory levels. If you assume that they were going to leave you with 50,000 of inventory and then you go and do a walkthrough and there's no inventory. What happened to the inventory that we said was going to be part of the deal? And you realize that the seller has not been replenishing or reordering inventory the last month as they've been selling, because they've been anticipating closing. So it's something to be careful with. You need to confirm all the conditions are cleared with the lender. You're going to wire funds to the closing agent. You're going to review the closing statement for accuracy with your attorney as well. Sign the documents. And then once everything's signed, you're kind of, you're getting access, right? And then typically, after that closing process, if the employees don't know, then usually it's like, okay, let's set up a meeting for the next day. The next morning, we're going to, introduce you to have the seller introduce the buyer to the employees, which can be a bit of a shock, right? And something to really think about as a buyer ahead of time. Like, what do I want that first interaction to be like, when it could be potentially pretty shocking for the employees. Same thing with notifying customers. You want to do that carefully and thoughtfully. And you're going to do things like changing bank accounts, credit cards, updating licenses, insurance contracts, and all of that work that needs to be done in that transition. Again, that's why we really encourage, make sure you've got built in like a 30 to 90-day window of time where the seller is going to stick around and help you transition those items, because you're going to need their help transitioning some of those things. But that's it. That gets you to closing. That's the process, not for the faint of heart, but if you can make it to that finish line, you are a business owner. And so hopefully this course has been helpful just to help set expectations. So that's really it. That's the end of the 6-part series here. So some key takeaways we hope you learned from the series. In course number 1, we just learned about why buying a business can be better in a lot of ways than starting a business. And sometimes starting versus buying does make sense, but a lot of times an acquisition is a great way to become an entrepreneur. In course 2, we talked about understanding the different types of SBA loans and what the typical terms and structures are, so that you can then look to find deals that are going to be SBA eligible, that are going to fit the SBA mold. So that's what we went into in course 3, is where to find deals. And then course 4, we talked about due diligence. So how do you analyze financials? How do you calculate sellers' discretionary earnings? How do you determine if a deal cash flows and whether it's a good fit for you? Course 5, how to assemble that lender-ready package and find the right lender. And then finally here today, just understanding that closing process and getting the deal to the finish line. So again, if you haven't watched all the other courses and you think any of those stick out to you, we'll put a link in the description of the video below so you can check that out, and just let us know if you have any questions. We talked about a number of different resources and tools. We've got a free SBA lender finder tool. I offer a free SBA review. So you can, again, we'll put in the description of the video below, we'll put a link to our free SBA review form. You can fill that out, and I'll give you some feedback on your deal, answer any questions you might have. We've got our acquisition projection template we'll put a link to as well. And then we've got some different paid services. We can do quality of earnings, kind of a quality of earnings light. We call it our quality of earnings sniff test. We have a SBA pre-qualification service. We build out custom projections and business plans, and we can really support you through the entire SBA application process if you'd like. So feel free to reach out to me directly at adam@ProjectionHub.com. We'd love to work with you on your deal. And that's really it. So thank you for being here. If you found this content to be helpful, we'd love it if you would like this video and subscribe to our channel. So we're going to put more and more content out to help support those that are looking to acquire small businesses. So we thank you for being here.